You've spent decades building your business.
Yeah.
You know the exact toll it took, like their late nights, the impossible decisions, all those missed family dinners.
Right, the massive personal sacrifices.
Exactly. All to create this enterprise of lasting value. You've built a real legacy.
But there is a very uncomfortable truth we need to confront today.
Yeah, and it's a harsh one. One lawsuit, a messy divorce, or, a sudden aggressive SARS audit could literally wipe out everything you've built.
Overnight.
Just gone.
Which is terrifying.
It is a terrifying reality for a lot of business owners. I mean, we spend an enormous amount of energy focusing on how to generate wealth, how to scale, how to acquire market share.
Yeah, the growth phase.
Exactly. But we spend almost no time figuring out how to legally and safely hold on to that wealth once we've actually created it.
Which is exactly what we are focusing on today. So welcome to today's deep dive.
Thanks for having me. We are looking at some incredibly eye-opening source material today. We've got excerpts from the definitive guide. It's called Legacy Preserved, a guide to strategic business succession trusts.
It's a fantastic resource.
It really is. And we're looking at that alongside the professional insights of Lumka Sturman, who is a highly specialized trust consultant operating right here in South Africa.
It's a really compelling combination of sources, actually.
Right, because we have the dense legal stuff.
Yeah, the theoretical framework from Legacy Preserved paired directly with the practical, on-the-ground reality of how a specialist actually applies these concepts.
Like how to protect actual operating businesses.
Exactly.
And our mission today is very specific. We are going to uncover the immensely positive power of trusts for South African business owners and investors.
Because it's not just about tax evasion or whatever myths are out there.
No, not at all. We are going to explore how to build what Lumka calls an asset protection fortress.
I love that term.
It's great, right? Because
Wow.
the ultimate goal here is to allow you to pass on your wealth, legally minimize your taxes, and protect your legacy.
All without losing control of your life's work.
Yes, because framing trusts as dynamic, strategic, generational tools, rather than just like a stack of legal paperwork you shove in a drawer, it completely changes the trajectory of a family's wealth.
It really does. It's foundational.
Okay, so let's start right at that foundation. Because when you talk to business owners, there is often this immense hesitation to use a trust.
Wow. Massive hesitation.
And it comes down to a fundamental tension, right? You want to transfer wealth out of your personal estate.
Mostly because you want to reduce estate duty and, provide for your kids.
Right, but you aren't ready to retire.
Exactly.
You don't want to rely on your children's goodwill for an allowance from the very company you built from the ground up.
That tension is what our sources call the control dilemma.
The control dilemma.
Yeah, because traditional property law is very binary. Basically, if you own the shares, you control the votes. And if you give away the shares to your children, well, you give away the votes.
Which is terrifying for a founder.
Completely. Most founders have seen, or at least heard, horror stories where someone handed over control way too early and the business was completely fractured.
Yeah, the sources give this very practical example of Mr. Naidu to illustrate this.
Oh, the manufacturing guy.
Yeah, so he's 62, spent 30 years building this manufacturing business, and he wants to start passing value to his 3 kids.
Which makes sense.
Right, so his first thought is the most intuitive one. He thinks, I'll just gift them the shares directly.
Worst thing you could do.
Let's walk through the actual mechanics of why that is a terrible idea.
Okay, so it seems like the simplest path, right?
Yeah.
But his accountant stops him and points out the mathematical reality.
A tax reality.
Exactly. If he gifts those shares directly, he is triggering an immediate donations tax.
Ouch.
And in South Africa, that is 20% on the value of the asset above the annual 100,000 Rand exemption.
20%.
Right. So if he's transferring, say, 10 million Rand worth of shares, he suddenly has to find nearly 2 million Rand in cash.
Just lying around.
Just to pay SARS for the privilege of giving his own business to his own kids.
That's insane. So there's a massive immediate cash flow hit.
Massive. And that's just the financial side.
Right. What about the control?
Well, as the kids accumulate those shares, he loses voting control.
Because shares equal votes.
Exactly. What if the 3 kids fundamentally disagree on the direction of the company?
Oh, that never happens in families.
Right. Of course not. What if one wants to sell to a competitor and the others want to expand? It is a recipe for family conflict and total operational paralysis.
So a direct transfer is basically a disaster.
Total disaster.
Which brings us to the concept of the asset protection fortress.
Yes.
The core premise here is your trust owns the assets, but your operating company carries the risk.
That's the key. It completely separates ownership from personal liability.
But earlier in the source material, there's a specific phrase used. It says, to achieve this, you have to separate beneficial ownership from control.
Yes, crucial concept.
Hold on. Before we go further, define beneficial ownership for me. Does that just mean, like, who gets the dividend check?
That is essentially it, yeah. Beneficial ownership refers to who gets the economic benefit of the asset,
Okay.
who receives the dividends, who benefits from the capital growth if the company is ever sold.
Right.
And the beauty of trust law is that it allows you to separate who receives that financial benefit from who actually makes the operational decisions.
Okay, let's use an analogy to make this mechanical.
Sure.
Let's think of the business like a car. If I put my business in a trust, the trust officially owns the engine and the chassis, right? The economic value.
Okay, I'm with you.
But through specific trust mechanisms, I am the only one legally allowed to hold the steering wheel. I get to drive the car wherever I want, even though I don't technically own the metal it's made of.
That is actually a much more accurate way to look at it. You can transfer the economic value out of your personal estate, but through specific legal mechanisms, you retain the decision-making authority.
Okay, that sounds great in theory, but how exactly does a founder keep the steering wheel, like legally?
Well, the sources outline a few highly innovative control strategies.
Okay.
The first is simply being a founder trustee. It is completely legal in South Africa for the person who creates the trust, the founder, to also serve as a trustee.
So you're literally sitting at the table making the decision.
Exactly. You are at the table.
But you can't be the only one at the table, right? Like, SARS isn't going to let you just talk to yourself in a mirror and call it a trust meeting.
No, they absolutely won't. Best practice dictates having at least one independent professional trustee.
Like someone who isn't a family member.
Right, someone who isn't family, to provide genuine oversight. However, you can structure the trust deed so that major decisions require unanimous agreement.
Oh, wow.
Yeah. So you essentially hold a veto over the entire operation.
Which ties into reserved powers, right? Because the trust deed is basically the constitution of your trust. And you can explicitly write into that constitution that the founder retains specific powers.
Even if they step down as a trustee later on.
Wait, really? What kind of powers?
Well, you can reserve the power to appoint or remove trustees.
Oh, that's huge.
It is. If you have the unilateral power to fire the people making the decisions, you inherently maintain a massive amount of influence over the direction of the trust.
Yeah, they're going to listen to you.
Exactly. You can also write in veto rights, meaning the trustees cannot sell a major asset like the business premises without your written consent.
The most elegant example in the sources, though, is Mr. Blamini.
The dual share structure.
Yeah. Yes. Let me break down the mechanics here, and you tell me where the friction is.
Go for it.
So, his family trust holds Class A shares in his business. Those shares have 80% of the economic rights, the right to dividends and capital growth, but absolutely zero voting rights.
Right.
Meanwhile, Mr. Delaminy personally holds Class B shares. They only hold 20% of the economic value, but they hold 100% of the voting rights.
It's beautiful.
It is. So he moved 80% of the financial value out of his estate, but he runs the show completely.
It is a brilliant corporate governance strategy for succession.
Yeah.
He protects the bulk of the wealth from his personal creditors and estate duty, but he never has to ask his children or the independent trustee for permission to hire a new executive.
Or sign a new supplier contract.
Exactly.
Wait, I need to push back on this, though.
Okay.
If I keep 100% of the voting power and I'm directing the company exactly as I was before the trust existed, isn't SARS or a creditor going to look at that and say, well, this is just a tax evasion loophole. You clearly still own this thing.
That's a fair question.
How does that not trigger alarm?
That is the critical nuance. The voting power Mr. Delaminy holds is over the operating company, not the trust itself.
Oh, I see.
Right. The trust is just a shareholder. As long as Mr. Delaminy respects his fiduciary duty as a director of the company and the trustees independently manage the trust's 80% economic interest, the separation is legally sound.
Okay.
But you are highlighting a very real danger. If you hold on too tightly or blur the lines between company, trust, and personal wallet, you blew the whole fortress up.
Right. And that brings us to the alter ego trap.
The entire premise of a trust relies on it being a genuine, separate legal arrangement. The trustees have a fiduciary duty to the beneficiaries.
Let's pause on fiduciary duty for a second. We hear that legal term thrown around constantly.
We do.
What does that functionally mean in this context?
Functionally, it means a legal obligation to put the financial interests of the beneficiaries above your own personal interests.
Okay.
You cannot make decisions that benefit you personally at the expense of the trust. The trust is not a personal piggy bank for the founder.
And if you treat it like a piggy bank, the South African courts will pierce the trust veil.
They absolutely will.
They will rule that you are treating the trust as your alter ego.
Because SARS and the courts look at substance over form.
Right.
If a founder makes unilateral decisions without ever having a trustee meeting.
Or if they use trust money to pay for their personal holidays.
Exactly. Or if the other trustees are just rubber stamping documents after the fact, the court will look at that behavior and rule that the trust is a sham.
And the consequences of that are catastrophic. Let's look at the Maharaj family case study.
Oh, this one is tough.
It is. So, Mr. Maharaj set up a trust in 2010 for his property investments. On paper, there were 3 trustees.
But in reality,
He ran everything himself. He collected rent from the tenants directly into his personal account.
big mistake.
Huge. He paid trust expenses from his own checking account. Then, in 2020, he goes through a contentious divorce.
And his wife's attorneys see right through it.
Exactly. They argue the trust is just his alter ego.
And the court agreed. They ruled that because he fundamentally ignored the legal separation between himself and the trust didn't legally exist for the purposes of the divorce.
Wow.
Yeah, 15 million rand in trust property was dragged right back into his personal estate and divided.
15 million.
20 years of succession planning was completely undone simply because he wouldn't hold a trustee meeting or open a separate bank account.
It's wild how an administrative shortcut can cost you half your net worth.
It really is.
But the family dynamics get even messier than just divorce.
Oh, absolutely.
The sources highlight Mrs. van der Merwe. She had 3 kids. One daughter is brilliant, works in the family retail business, and is totally capable of running it.
Okay.
Her son has 0 interest in the business, but he needs financial support. And her youngest daughter, unfortunately, struggles with severe addiction issues.
That is a very real, very human scenario.
Yeah.
And it proves exactly why a standard template trust printed off the internet is incredibly dangerous for business owners.
Oh, definitely.
If Mrs. van der Merwe put everything into one standard trust that treated all 3 kids equally, it would be a disaster.
Right, because if you just do an equal 3-way split, you have major operational problems. A business owner listening to this knows exactly what happens.
Yep.
The capable daughter is going to resent working 60-hour weeks just to generate dividends for siblings who contribute nothing to the bottom line.
Not to mention the risk of giving a beneficiary with addiction issues equal unrestricted access to large sums of capital.
Yeah, that's scary.
It could literally be life-threatening.
So let's look at the operational impact of what she actually did. How does she structure this to treat them fairly but protect the business?
She needed deep nuance.
Yeah.
So she set up 3 different structures.
3.
Yeah. First, a business trust primarily benefiting the capable daughter.
Okay.
Operationally, that daughter receives a market rate salary from the operating company for her labor. Plus, she receives the lion's share of the dividends flowing into the business trust to reward her for growing the company's value.
That makes total sense. What about the other 2?
She set up a separate trust for the son to provide a steady, capped income stream.
Like from real estate.
Exactly, funded perhaps by fixed property assets rather than the high-risk operating business.
Smart.
And finally, a heavily protected trust for the youngest daughter. In that trust, the trustees have absolute independent discretion over all distributions.
So she can't just demand the cash.
Right. The money pays directly for care, medical facilities, and housing, but the daughter never has direct access to the capital.
It really emphasizes that trusts are about protecting the family from themselves just as much as protecting them from the outside world.
That's a great way to put it.
Okay, so family dynamics are the emotional hurdle. Let's pivot to the financial hurdle, the tax labyrinth.
Yes.
How do these fortresses actually save you money, and where are the hidden traps?
Well, the biggest motivator for most founders is estate duty. In South Africa, estate duty is incredibly steep.
How steep are we talking?
You get an exemption on the first 30 million rand. After that, you are hit with a 20% tax rate.
20%.
And anything above 30 million is taxed at 25%.
Wow.
Think about a founder who spent 30 years building a 50 million rand manufacturing plant. On their death, SARS could take a massive chunk of that value just in estate duty.
The business might literally have to be liquidated just to pay the tax bill.
Exactly. It destroys the legacy.
But if you transfer that business into a trust while you're alive, it's a completely different story. Walk us through the Mr. Reddy case study.
Sure. So Mr. Reddy transferred his 25 million rand business to a family trust at age 55.
Okay.
He stayed on as an employee and director, drawing his normal salary, and served as a trustee with independent oversight.
So he kept his income and his control?
Right. Crucially, when he died at 72, the business was no longer legally his. It was not in his estate.
Oh, wow.
By moving it early, he saved his family approximately 4.5 million rand in estate duty.
That is a staggering saving.
It really is.
But trusts are notorious for having terrible income tax rates. They are taxed at a punishing 45% flat rate on any income they retain. How does that make any financial sense?
Yeah, that 45% rate scares a lot of people away.
Mm.
But the secret weapon here is the conduit principle.
The conduit principle.
This principle allows trustees to distribute income like business dividends through the trust directly to the individual beneficiaries.
And when you say through the trust, you mean the trust acts like a pipe, not a bucket?
Exactly the right visual. The income retains its nature as it flows through the pipe.
Okay.
So if a dividend flows to the trust to a beneficiary who is in a much lower tax bracket, say, a child at university, it gets taxed at that individual's marginal rate, not the trust's 45% rate.
Oh, that's brilliant.
It is highly efficient if your trustees understand how to utilize it.
But SARS isn't stupid. They see these strategies and they constantly introduce anti-avoidance measures. We have to talk about the absolute nightmare of Section 7C.
Section C, yes.
Why did SARS introduce this and how does it actually work?
To understand Section 7C, you have to look at the loophole founders were using before 2017.
Okay, what were they doing?
Historically, the way you funded a trust was to sell your business or property to the trust. But the trust didn't have the cash to buy it, so the trust would owe you the purchase price on an interest-free loan account.
So the founder transfers a 20 million rand asset. The trust owes the founder 20 million, but the loan doesn't accrue interest.
Yes, the asset grows in value inside the trust, tax-free from an estate perspective, while the loan value in the founder's personal estate stays exactly the same, effectively shrinking due to inflation.
That's a massive loophole.
SARS realized founders were infinitely parking wealth in trusts and bleeding estate duty revenue. So in 2017, they introduced Section 7C to shut it down.
And the mechanism they used is brutal. They basically said, no more interest-free loans.
Under Section 7C, if you give a trust a loan at a below-market interest rate specifically, below the official SARS rate, SARS treats the difference in interest as a deemed donation from you to the trust every single year.
This devastated the Govender family in our sources, not the successful Govenders we'll talk about in a minute, a different family.
Right, the first Govenders.
Let's look at the math on this. They had a 20 million rand interest-free loan to their trust from way back in 2005. It worked perfectly for 12 years. Then 2017 hits and Section 7C kicks in.
Suddenly, because the official interest rate at the time was around 8%, SARS looked at that 20 million rand interest-free loan and said, you are effectively donating 1.6 million rand to this trust every year in unpaid interest.
And a 1.6 million donation triggers a 20% donations tax. That meant an actual out-of-pocket tax bill of over 320,000 rand every single year.
Just brutal.
A structure that was legally sound for a decade suddenly became a massive financial liability, forcing them into a desperate, expensive scramble to restructure.
It really highlights the danger of static planning.
So what does this all mean for the listener? If the rules are constantly shifting and SARS is deploying complex anti-avoidance rules, how do you play this game without accidentally stepping on a landmine like the Govenders did?
The primary takeaway is that DIY estate planning is incredibly dangerous.
Yeah.
You cannot afford to print a template, implement a structure, put the documents in a drawer, and assume you are protected forever. The stakes are simply too high.
You need an expert.
You need a specialist who understands the interplay between corporate law, trust law, and tax law.
Which brings us to the insights of Limke Sturman.
Yes, Limke.
As a specialized trust consultant, what stood out in her approach is that she translates all this dense, terrifying legal jargon into practical, diagnostic steps.
Her approach is very refreshing.
Because generic advice just does not work for an operating business.
No, it doesn't. A trust designed to hold a passive property portfolio looks fundamentally different from a trust designed to hold an active logistics company with 50 employees.
Obviously.
Lumka focuses on what she calls fortress checkups, ensuring that as your business evolves, your legal protection actually keeps pace.
Rather than just selling a product, the sources highlight her diagnostic approach, specifically the foundation audit.
Right.
This isn't just a consultation, it's a structural stress test. When a specialist conducts an audit like this, what specific red flags are they looking for?
They are looking for the exact landmines we've discussed. They review the trust deed to see if the founder has retained too much unchecked power, risking the alter ego trap.
Right.
They analyze the loan accounts to see if there is Section 7C exposure. They check if the independent trustee is genuinely independent or just a friend rubber-stamping decisions.
Finding the cracks before they break.
Exactly. It is about finding the cracks in the fortress before SARS or a creditor finds them.
If you want to see how this translates to your specific situation, her website, lumcastdurman.com, actually outlines these diagnostic steps, from the initial audits to comprehensive asset protection blueprints. It's a great resource for understanding the flow of assets.
Some business owners hesitate at the cost of professional restructuring,
Sure, it can seem like a big expense up front.
but we have to contextualize it. This is a critical investment. You are paying a fraction of a percent of your business's overall value to ensure you don't lose millions to estate duty or lose everything to a disgruntled spouse in an alter ego divorce claim.
The ultimate success story from the sources proves exactly that point. Let's look at Mr. Rajan Govender again, different family from the Section 7C disaster.
The successful governors.
Right. Rajan is 63, and he built a 40 million rand wholesale distribution business. He also has a 12 million rand commercial property portfolio.
Very successful.
His son, Vikram, is the operations director, but Rajan is not ready to hand over the reins entirely.
It is the classic control dilemma. But by working with a specialized team, Rajan implemented a phenomenal multi-layered structure. He didn't just use one catch-all trust.
What did he do?
He set up a business trust, specifically for the company, a separate property trust to isolate his real estate from the business risks, and an education trust to provide for his grandchildren.
And for the operating business, he used that exact dual share strategy we analyzed earlier.
He did.
The business trust bought 80% of the economic value through Class A shares, and they funded it using a Section 7C compliant loan that slowly gets paid off through the business dividends.
Right.
Meanwhile, Rajan kept the Class B voting shares in his personal capacity.
The outcome of that engineering is brilliant. Rajan kept 100% voting control over the distribution business.
He still drives the car.
He still drives the car. He mapped a clear, structured path for his son Vikram to eventually step up to CEO. He provided financial security for his wife.
And the tax.
And, crucially, he saved an estimated 6 million rand in future estate duty.
6 million.
That is the tangible power of proactive professional guidance.
It really is massive. If you are listening to this right now and you are generating serious income and building assets entirely in your personal name, you are exposed.
Highly exposed.
You need this level of structural protection.
A trust, when implemented and maintained correctly, is the ultimate generational tool. It is not about avoiding taxes illegally. It is about optimizing your hard-earned wealth within the boundaries of the law.
Exact.
It's about securing your family's future and ensuring the business you sacrificed so much for actually survives beyond your lifetime.
Absolutely. The best time to build your asset protection fortress was 10 years ago. But the second best time is right now. Your business deserves a future that is as robust and successful as its past.
And you deserve the peace of mind knowing that your legacy is actually secure.
But before we wrap up today, I want to leave you with one completely new thought to mull over. We've talked extensively today about physical traditional assets,
Right.
brick and mortar businesses, commercial property portfolios, manufacturing plants. But what about the digital age?
Oh, that raises a fascinating point regarding succession.
Right. If you are a founder whose wealth is entirely tied up in a personal brand, massive social media account, software code, or purely digital IP, how do trustees effectively manage and protect an asset that only exists in the cloud?
That's tough.
especially when trust laws are fundamentally ancient and still scrambling to catch up to the reality of the internet. How do you build a fortress in the cloud?
Now there is a control dilemma for the modern era.
Because at the end of the day, whether your business is made of concrete or code, you've sacrificed too much to build it. You don't want a single glitch, lawsuit, or audit to wipe out your life's work. Until next time, keep digging deep.